Hey, what's up, everybody? It is Tuesday, May 3rd. So, quiet day, everybody in anticipation for tomorrow. We got the conclusion of the Fed meeting, and they're going to raise rates by 50 basis points. This has been so anticipated. I've been in this business a long time. I don't think I have ever seen a Fed policy shift that has been so anticipated as this one. And frankly, I'm excited. I'm looking forward to it. I hope we get a series of rate hikes because I want to test my theory. And that theory is one I have been talking about now for a while. It's, the Fed, because it has to pay interest on reserves, and that comes out of its own earnings, how much can it really raise interest rates before it faces a situation of having negative cash flow, negative equity, and that requirement to pay interest on reserves? I just want to see that put to the test. Now, like I've said so many times in the past, theoretically, there's nothing stopping the Fed from continuing to pay those reserves and having negative cash flow, but then it's not going to have money to hand over to the Treasury at the end of every year, and it's going to attract attention from Congress. So I'm curious. I want them to go to 2.5% on the policy rate. I want them to see if they can go to 3.5% on the policy rate. I'm more interested in that or concerned about that or curious about that than what I think the impact on the economy and the stock market is going to be. Look, right now, the main thing that I'm concerned about, and I've been making a couple of videos on this, is the fiscal situation. We've had a huge contraction in the deficit. The deficit is the net transfer to the non-government. That's all the spending minus all the taxation. And the bigger that deficit is, the bigger the net transfer to the non-government, the economy. And that increases the financial balances of the economy. It makes the economy more financially sound. And when the government shrinks that deficit, that is a net transfer from the economy back to the government. It makes the economy less financially sound. So that is my concern. We've seen right now 1.3 trillion reduction in the deficit year over year. We're at 521 billion right now this fiscal year. And again, people say, well, where'd you see that? Where's the data on that? Well, I just calculated off of the daily treasury statement. And again, you can get that off of my website. I have a video course called Understanding the Daily Treasury Statement. It's $99. And look, the daily treasury statement, I've said this a million times, is the greatest resource out there. It's free. The Treasury puts it out every single day at 4 p.m. Eastern Time. It is literally the checkbook of the United States government. If you have a checkbook, you got your deposits, you have your withdrawals. It's every single, line item of deposit. It's every single line item of withdrawals. And I show you in that video course how to calculate those daily flows, like what's going out and what's coming in. And that drives everything. That's my concern. We've had a very big contraction in the deficit. We're still going to run a deficit for this year. And it's probably going to end up being, over, close to 2 trillion or maybe even over 2 trillion. Last year it was a 2.9 trillion. Look, we're already 1.3 trillion below. So we're going to run something like a 1.6 trillion. Historically, that's still a big deficit, but it's a big reduction from what we had last year and the year before. I think the year before that was like 2.7 trillion. So it's a big drop. And again, that drop constitutes or equates to a transfer from the economy, from us, back to the government that, makes the economy less financially secure. That's a problem. As far as interest rates are concerned, I'll say this again. To me, I look at it the same way as I look at inflation, the same way as I look at deflation. It is a redistribution of income. I don't know why so many people have a problem understanding that. I mean, we see this very clearly now in corporate profits. Corporate profits are breaking historic levels because pricing power has been restored. Sorry. So we pay more as consumers, and that hurts, and I get it. There's more of us consumers than there are producers. So the narrative, the story is clearly going to be about our pain. There's no question about it. I mean, media-wise, commentary-wise, politically, it's going to be all about our pain in having to pay more. But it's a zero-sum game. I mean, we are paying more to someone, and that someone, or those someones, are producers. They're corporations that have the ability to raise price. They're farmers. They're energy producers. I mean, it's just a redistribution of income. Now, I've said this, the income doesn't fly out into outer space, but some of it does transfer to the foreign sector. We run big trade deficits. The United States does. So, yeah, we lose that. That goes away. That goes to the foreign sector. But if you consider the global economy, we talk about that phrase is tossed around all the time, the global economy, it gets transferred to the foreign sector. It's still in a big, giant pot. It just, it gets circulated around. So I don't look at it necessarily as something horribly negative. I don't like paying higher prices. No consumer likes to pay higher prices. But I mean, if I was a farmer and I'm getting paid more for my crops, I'd like that. You have to understand there's two sides to the coin. Deflation is the opposite thing. It's good for us as consumers. Prices come down. It's bad for producers. The profit margins get squeezed. But then what happens is they have to cut costs. So, I mean, then you might see higher layoffs or whatever. Anyway, same thing with interest rates. Interest rates, if we're paying more as a debtor, if rates go up and we got to pay more on our credit cards or more on our mortgage payments or whatever, somebody is receiving that money. Now, it may be the financial sector, and that could be kind of hoarded or saved in the form of retained earnings or higher profits. But I mean, isn't that good for stocks? I mean, isn't higher profits once again, it's like the dichotomy between consumers and producers. There's going to be a cohort that gets hurt. There's going to be a cohort that gains from that. That's the way you really have to look at it. All this hysteria, and I mean, it's been non-stop hysteria. The other thing, I've been talking about, is the QT. Same thing. I mean, what is QE? QE is more reserves and less government securities. All right, they're both dollars. One is a dollar. Hang on. One is a dollar, with zero term. In other words, cash. One is a dollar with a term. 30 days, 60 days, 2 years, 5 years, 10 years. But that dollar earns interest. Okay. So QT. What is QT? It's more securities, more government securities, and less reserves. The quantity of dollars has not changed. The composition of those dollars has changed. Again, this is, I think most of you understand this when it's explained to you, but it's not, for the most part, it's never explained. It's talk about draining liquidity. I'll tell you what was a liquidity drain. I did tell you what was a liquidity drain in my video yesterday, and I think on Friday. We had a massive government tax haul. Now that's a real true liquidity drain. That's taking your money away, okay, and not replacing it with another form of money, okay? It's not like when the Fed does QT, again, it's taking the bank reserves and it's replacing it with government securities, which are, those are dollars, again, with a term and a coupon, plus they earn interest, so it's actually a net fiscal expansion, all else equal. But a tax collection, you know what that feels like. I don't have to explain to you what that feels like. Let me ask you something. Let me just pose this question to you, all right? If I had $10 million in cash and you have $10 million in treasuries, do you think I'm richer than you? I mean, think about that. If I had $100 million in cash and you have $100 million in U.S. treasuries, would you say, like, I'm richer than you? No, you would not. You would actually even say that you're richer than me because you're going to be getting the interest on that. But yet, that is the narrative out there. That's what people think. But that's all it is. I mean, that's all it is. So if we switch the situation around, if I gave you $10 million or $100 million in cash, and I have $100 million in treasury securities, do you say you're richer than me? I wouldn't think so. That's all it is. I mean, that's the way to understand it. That is exactly what is going on here. But there is like such an incredible hysteria attached to this that I just, again, I want to see what's going to happen. I'm curious to see what's going to happen. I'm bullish on the whole thing. I think the level of hysteria is through the roof right now. I mean, every kind of sentiment reading or indicator that you could look at it kind of backs me up on that thing. Even taxes. Let me just say this about taxes. While it hurts to pay taxes and that money goes out of your account, okay, that money is recycled back right out in the form of government spending. Now it's redistributed. I maybe pay taxes and it doesn't mean it comes right back to me. It goes back out into the economy. But, if you're a productive person, eventually income flows back to you. If you're not a productive person, then some of those taxes may go to support you. I don't know. It depends on government policy. But the point is, yes, it's taken away in one big chunk on April 15th or April 18th it was this year. It gets spent right back out again because we run fiscal deficits. If the government was running a surplus, like a constant surplus, that would be a problem. That would be a problem because that would mean it's not, those tax collections are not put back into the economy. They go into the black hole of the government's ledger, and that's where they stay, and it never gets recycled back into the economy. So I'm not into all this hysteria, but I will say this, that the liquidity drain, and that was a true liquidity drain, the liquidity drain from the tax haul in April. I mean, you saw what was happening, that the stock market was starting to stabilize, it was starting to rebound. We had solid corporate earnings. Everything was looking better. I was talking about it, and I should have been aware of it. I was aware of it. I don't like to adjust for a short-term thing, which is the way I look at the whole tax situation. Is, again, for me, it gets recycled back out. You have maybe a month or a 6 weeks period where it's kind of shaky because of that liquidity drain, but by the summer, that's why they always say there's going to be a summer rally. I mean, that is a reflection of that tax haul being, re-injected back into the economy. That's why we have these seasonal things like sell in May and go away, and then the summer rally. So, I didn't want to adjust because for the period of a month or 6 weeks, but what can I tell you? So anyway, tomorrow's a big Fed day. We'll see a lot of volatility. I think all of this stuff is already priced in. Look, I could be completely wrong. and all the naysayers might be right, and all the doomsday people might be right, and the whole thing goes to hell in a handbasket. I mean, frankly, I'm much more worried about the war and that escalating, because it really looks like it's being pushed in that direction. I mean, more arms to Ukraine, no peace negotiations at all. I mean, it's a terrible, terrible situation. People dying, the whole country destroyed. What are you gonna do, man? Anyway, that's it for today, folks. I made a video earlier trying to explain, how the government doesn't have an inability to pay. Look, these are all just ledger entries. It's just accounting. That's it. It's just accounting. That's it. It's ledger entries. It's bookkeeping. That's it. It's no big deal. All right. Don't forget, if you want to check out my report, MMT Trader, go to my website. I'll put the link here, pitbulleconomics.com. Sign up for a 30-day free trial. Bye.